So anyone who shorts silver then is going to be incentivized to cover their shorts faster and faster, and that could actually lead to quite a squeeze on inventories and then the price. So there's that potential exists now. A true silver squeeze could be taking place.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today we have an incredible discussion lined up. We're fortunate to have with us Peter Spina, president of GoldSeek and SilverSeek. Since 1995, GoldSeek.com has served millions of readers with the latest gold news and information. GoldSeek.com continues to lead and connect the gold investor community with up-to-date information on the gold markets, providing visitors with live gold prices, covering and analyzing the gold mining and exploration companies, discussing gold as money and related topics, and sharing many expert articles and reports. Peter, welcome to Metals and Miners. Thank you so much for joining us today.
Thanks for having me on, Gary.
All right, so everyone's who's interested in the space has heard all about the flow of gold from the LBMA to the COMEX. Gold is being repatriated to the USA. What is it that has spooked the world's savviest investors to suddenly park as much gold in vaults some 100 feet below Manhattan as they did when the world was stockpiling during the pandemic and they thought the world was ending? Is this a response to tariffs? Is this a response to the BRICS, a brewing problem with the banks? What is really happening here?
Well, there are definitely multiple drivers behind gold demand. We've seen investment demand go up in the West recently, but the recent driving force between repatriating the gold back from, bringing gold over from London to New York vaults is really an unusual situation that we really don't see often in the paper markets, which is actual delivery, asking for physical delivery of these future contracts. Most of the time, the futures market is just a paper game. It's a use for hedging and playing games with the speculators and other things. But now we've got a situation with the threat of tariffs coming, threatening potentially the price. Even if you were going to slap on a 10-25% tariff on incoming physical metal, that would be quite the problem for a lot of those who are short metal and those who do not want to pay a higher price. So there's been a rush into physical. We've had a record amount of deliveries from the COMEX. The last week we had the first day of delivery notices put out, and that was a record amount. So there's several million ounces of gold and much more of silver, of course, being demanded. This is creating quite the strain on the physical, limited physical inventories out there, which have been drained for quite some time because of the other issues you have mentioned.
Yeah. So, Peter, every dealer and refiner of gold and silver, they're saying, there's no demand for these metals. I'm swimming in coins. I have tons of industrial gold products that usually sell at premium to London. They're being offered at a discount. Nobody wants them. Yet, COMEX warehouses are going to be stuffed with tons of this stuff. Like we said earlier, this has shades to the massive glut that formed during the early days of the pandemic panic. Is this time going to be different?
Well, the retail has been missing. Retail side in the precious metal markets has been dead for years. Various reasons. You have different hot markets, the AI, crypto mostly. A lot of, especially silver buyers went into the crypto coins. So obviously lots of quick, easy money's been coming in through there. So that has led to the lack of interest. And actually you see dealers being like you said, they're getting calls. They have more people looking to sell than buy recently. The trend is slowly shifting. You see that with the ETFs, silver, gold ETFs, back in, I think it was Q3 last year, after years and years. There was a little bit, I think, under the 2022 Russian and Ukraine war. There was a bit of a pickup. But for the most part, for years, there's just been a lack of interest by the Western investor. The gold and silver markets, the driving force is overseas. There's massive record demand from central banks to retail buyers in China, but in the West, that's totally opposite. So I believe that's been bottoming out nicely here. It's quite amazing to see the silver price and the gold price do what they have done and not get noticed yet by the general public. But I think that's about to change.
So I do want to touch on China in a moment, but in 2013, Donald Trump shared on social media the following. He said, "The golden rule of negotiating, he who has the gold makes the rules." So now he's negotiating with the whole world through tariffs and such, and we see a repatriation of this gold to the U.S. happening over the last week to 2 weeks. Is there a coincidence here?
I mean that interesting point. I think he does understand what gold means in the international global markets and the context. That is definitely there's a bigger problem at hand, and it's the U.S. dollar, which has been the gold standard of currencies for the last half a century, and that's not that's not going very well. There has been a general move out of the dollar for many years, but the acceleration, the de-dollarization acceleration, has after 2022's events in Ukraine sparked a massive move and pushed the timelines way more forward. So yeah. Well, there's a lot of questions about gold holdings in the U.S. How much gold is actually maybe not held? It's being held probably all in Fort Knox, but who is it unencumbered? Who owns? Are there multiple claims on this gold? Has it been leased out? Because that's been a big feature by a lot of central banks, and then we've seen that talking about the Bank of England and the LBMA. There's huge weight. 4 to 8 weeks wait for physical deliveries. So what exactly is going on? There's a lot of speculation, and it's hard to know exactly what the truth is. But you look at when the Germans tried to repatriate their gold from the US, it took years, and they only took part of it, and they had to not get as much as I think they initially wanted. And the Venezuelans, well, that's a different situation, trying to get their gold out of London. But there is a lot of questions about how much physical gold is owned or has been leased out, and who owns the claims on it. So there's, Trump has brought in an interesting U.S. Treasury Secretary who understands the Bretton Woods Accord. He teaches, he's a hedge fund manager, but he does teach at Yale, and I believe one of his main focuses has been on this issue, and that's really unraveling. That the dollar standard is being challenged, and we're seeing very aggressive moves. Obviously, Trump understands gold, but he also understands how to play a tough game, and he's mentioned on BRICS side, you try to ditch the dollar, and we're gonna tariff you 100%. So it's lots of aggressive, absolutely, very big aggressive moves being made. It's just accelerating the demand for gold into safety, a safe haven, among other things.
Yeah, and to your point about all these aggressive moves, it's definitely introducing a lot more volatility into the equation right now, and I believe Scott Bessent's largest position that he had stated publicly going into the election was gold. That was his biggest. Yeah.
Yeah, that was quite the I listened to that podcast interview he was on. And it was November 4th, so it was right before the elections. And to hear him talk like that, wow, that was kind of a shocker. You don't usually hear that from a U.S. Treasury, an incoming U.S. Treasury Secretary.
Right.
And he mentioned in that program that he would like to be involved either externally or internally on renegotiations of the Bretton Woods Accord and the new future of trade agreements and how this new world is going to work. Because I don't think you're not going to go around the world threatening unless if people should be willing to use your product. So if you're going to go around and start threatening people, it means there's a big problem. So it's kind of like it feels like we're at the end stage of the dollar empire. And these are the last kind of moves that you have, is to go around with a big bat and say, use the dollar, or else you're not going to get access to this huge consumer society. I mean, but there's a lot of other things involved, obviously, with the tariff situation. And I understand some of the moves, especially with, the U.S. has a big problem domestically with its debt and consumer-based society. So
I think your points are fair, and I think it's all pointing to some kind of deal, new monetary restructuring, that needs to occur in order to make things work a little bit better for everybody. So, Peter, while the gold, you brought up China a moment ago, while the gold space been obsessed over the gold streaming from London to New York recently, China is another huge story. They've been quietly stockpiling gold at a frenetic pace. Direct gold exports from the UK to China, a proxy for the PBOC, that remained impressively strong in November at about 50 tons. So as the Chinese central bank in 2024 has secretly bought as much as 600 tons with 50 billion US dollars, it seems as though China is pretty confident about something. What's your reaction?
Well, China announced in November that after a 6-month pause, they started to officially buy gold for the central bank, the People's Bank of China. Now that was kind of done, I think, on purpose because of the elections. But as has been stated, it was kind of obvious that their gold buying never really slowed down. It's obviously been very strong for not just last year or years, whatever. This is decades. They're building up a huge stockpile. What they officially state is, it's not probably the truth. They probably have a much larger position, but they're eager to keep accumulating. And it's just not the central bank, the populace or the retail side was absolutely on fire last year or just over a year ago. It's picking up again now. And what's interesting about that, I like to point this out because everyone talks about crypto and so on in the West, so focused on these coins, and well, that is, the young generation is not interested in physical metal, but the primary buyers, in China were 25 to 35-year-olds, and soon it's going to be sub 25-year-olds. In India, very similar. It's the culture there is much different, and they see gold something that they hand down through their savings, through generations, and they also see it in the new global context as a currency that needs to be there for them to get some sort of BRICS trading arrangement done, because in BRICS, the Chinese yuan, it's maybe the anchor, but it's not the most trusted. There's capital control issues and other things involved in China, but gold it comes down to trust, and gold doesn't have the counterparty risk. It doesn't have the trust issues that all these other currencies have. And we've already seen problems with the BRICS trying to trade amongst each other. When Russia was exporting all this oil to India a year or two ago, they were piling up with rupees in Moscow, and they said, okay, well, what are we going to do with all this? You're not sending enough stuff to us. So it's a problem. How do you balance out all the trade? And gold is an excellent tool. So I think that's a big driving force behind the BRICS nations accumulating heavy amount of metal, precious of gold, and that's not going to stop anytime soon, especially now with more threats, trade war threats and so on. So they're really, this is the Colder War 2.0, or they call it the freezing war, where we're going kind of back, we're deglobalizing, and things are unraveling. And that also means the dollar standard is unraveling too.
And again, more volatility. So you're talking about the BRICS here. President Trump, he's threatened the BRICS, as you said, with 100% tariffs if they move forward with any attempt to circumvent the U.S. dollar. How do you expect the BRICS alliance to respond to that? And what would the impacts on precious metals be based on their response?
Well, it's a problem for them. China doesn't want to spark a huge trade war. They're still dependent on our markets, less and less so, but they're still they have their own issues and trying to grow and don't want to disrupt that. But they have longer term visions. They're willing to go through some pain to outmaneuver us longer term. I still don't understand it fully, because if you're gonna even put a 10% tariff on China, that's nothing. That's actually kind of a joke, because they can undercut us, and so price wise much more. So you would need 100, 200, 300%, or I don't know at what level exactly is where you become competitive. So, but the net result is going to be this: it's going to drive them more to create their own trading agreements among other countries and change the way the trade structure works. and it's part of the incentive too. Is what Trump's trying to do is trying to bring back some sort of domestic production because it was gutted by this system for decades, from both parties for decades. Everyone, the big multinational corporations to these politicians, everyone was getting so enriched. The consumers, they loved it for the last decades because they've had the strong dollar to go buy a bunch of cheap stuff overseas. And then the problems are accumulating. The debt is accumulating. The trade deficits are running wild. Internal deficits are running wild. The dollar, it's at risk. We're getting to these debt levels where things have to be resolved. So these things are going to create problems now. Can they respond and put tariffs on the U.S. and try to play the game and escalate it? I don't know. I don't think they will be as aggressive. I think they'll kind of try to be a little more submissive to these threats and not try to push Trump. I think they want to kind of keep building what they're trying to build first, because they still have a lot of challenges and things are still not established.
Well, it definitely bears watching for sure. Peter, gold hits a record all-time high. It's currently pushing, I don't know, around $28.50 an ounce. It could be a little higher while we're talking. Media coverage remains eerily quiet. Despite a 70% price surge since 2020, news mentions of gold are at historic lows. Why is the precious metals meteoric rise flying so far under the radar?
It's shocking. I mean, you really would think at this point you would have front page coverage. It's not happening. You're getting front page coverage of Bitcoin and Trump and meme coins and stuff like this. And this is just, it's like the casino gambling mentality. Everyone's looking for the quick gains. They're not looking at fundamentals. They're not there's I don't think most people in the West understand how serious things are globally and things that are occurring. So the bull market has happened in Asia and Middle East and parts of Europe. They understand it a lot more over here. And the gains in AI and crypto are incredible and quick. So it's easy money, and the cheapened values of today are being represented with all this trying to chase this. And it's been, some people have even mentioned, well, maybe this is a great opportunity to suck up all this excess liquidity, dump it in by the tens and tens of billions into Bitcoin and crypto. And meanwhile, you're not driving up the gold and silver price more aggressively, not competing for the limited inventories. But I don't know. I think that's just more of that's just kind of, well, you definitely do have some, this marketing by some of these big players, Saylor and even BlackRock and these guys saying, no, this is a new digital gold, and just trying to confuse people. So it's actually been negative coverage, I would say. And they, they establish the system, and this goes even with Trump and the new Treasury Secretary. You don't want to be advertising gold. That's your competition. You don't want to gold at 2,900 almost now. That's showing the weakness in the dollar. The fact that we're at these levels isn't, just showing how that gold's strong, is showing that the dollar is weak, that the dollar is hitting record lows, the purchasing power of the dollar is falling. That's very serious. That's a very dangerous indicator. And I don't think they want to be exact. The media maybe doesn't want to be stoking any more interest into that market. They're probably busy, building their own positions or so on. But I'm shocked that you haven't seen much more interest. But it makes sense, that you're getting more interested by these easy casino coins and so on, and people are just distracted. Which makes me then also wonder, when they do wake up, when they do join this global gold and rush, boy, where does that take us price-wise? Because again, the inventories are tight.
Yeah.
And,
Yeah. So speaking of, being distracted and asleep, so to speak, GLD shed 8 tons of gold in January. It's still down 300 tons since 2020. Gold is in a central bank driven bull market for the first time in history. And U.S. money managers, they just don't care. What brings the money managers who push the big money around to the gold table?
Yeah, it's quite amazing. Central banks are increasing their levels of gold to levels we haven't seen since World War II. But as a percentage of their balance sheet, is still quite small. So there's a lot, more room for them to keep accumulating. So they're going to continue to support this market. When does the West? What makes them become more interested? Well, I think you're going to have to see some of these bubbles pop. If they're doing well in the AI side, and well, maybe we might be facing something sooner. I think the markets do have a lot of energy and potential to still go higher first before they get hit. But at some point, we're going to get hit hard, and all of a sudden, all these hot stocks and crypto stuff that this easy money has been pumping up, suddenly you get a rug pull. Well, all of a sudden you get a wake up call, and reality check comes in. It's like, okay, well, this is not good. We can't keep playing high risk games here. So you'll see the performance of gold, and I think if they're smart enough, they will see the value, especially in the gold stocks, which are trading at absolutely decimated, depressed levels compared to the gold price right now. So, and there's a chance for them to actually do quite well. But yeah, it's
so basically the huge shadow that AI and crypto and some of the other big movers have had over the last few years, that shadow that's been cast over gold. But if that shadow starts to shrink, then they're going to be looking for some less risk, more reliable gains. And it's pretty obvious. Look at how gold is. It's a 5,000-year history, and look at how it's performing. That's what you see.
Yeah, that's one of the triggers. I think it's outperformed a lot of assets and markets recently, so it's going to start getting more and more notice. I think on the miners side, it doesn't even need that. You're going to see some excellent quarters, and the valuations become so appealing. And you've already heard from some of the companies when I talk to them what's going on with investor interest. Well, yeah, it's pretty much dead retail side, but you do get some generalist funds out of New York, out of the East Coast, starting to take a look. So it may start that way too, where you get a slow building interest, and then the word kind of gets out. It's like, wow, look at this sector. Look at everything else out there. Look at the valuations. Look at their growth. This is not a short-term move in the gold price. This is sustained. We're not getting slammed, and that's building more and more confidence. So those things also might trigger this.
Yeah. So we're going to definitely touch on the miners, but Peter, the U.S. imports about 150 million ounces of silver each year, primarily from Mexico and Canada. Now 25% tariffs have been enacted by the Trump administration, although I think right before we came on, Mexico came to the bargaining table and they've pushed the tariffs out 1 month. But either way, in your analysis, what does a 25% tariff do to these prices, the silver prices in the U.S.?
Well, if you're going to have to pay a lot more for silver importing it, the incentive is to build your more silver mines, to buy cheaper silver domestically. So I think, well, the first result would be go for the cheapest silver, which, there's other countries you can change depending how many tariffs Trump layers on. But they're going to go for the vaults. They're going to start redeeming more and more shares of ETFs, or delivering on the futures market. So as long as they can drain some of the existing physical supplies, they'll pay the cheaper price. I don't know if it's going to narrow. So the price 25% is a huge increase. But when you look at the manufacturers, silver input costs, it could double or triple. It's not going to be huge influence on their final product. So it's they might just absorb it more easily, maybe than the gold price. But it definitely puts a lot more interest on domestic suppliers or domestic inventories. So you'll see a real big drain on that first. And if you're going to be trying to incentivize manufacturing in the U.S., which is going to demand more and more silver, I think we're down to 5,000 or so tons a year of silver demand in the U.S. We were up way above that years prior. And if we are going to be pushing more and more of that back, there's going to be a huge problem with supplying it. And it just kind of, what I think the most interesting part is, the potential for a squeeze on the remaining inventories. So people are going to anticipate this and say, well, we're going to get into a deeper shortage. And with silver, we're already nearing or entering year 5 of a structural supply deficit. So massive amount of shortages of silver that has been fed by the selling of the ETFs in the West for a few years, the lack of silver and interest investment. But the London LBMA hit their record low silver holdings, and you're going to you're going to find people running, investors joining the actual manufacturing side back in the silver price. You just have an absolute rush into it. So anyone who shorts silver then is going to be incentivized to cover their shorts faster and faster, and that could actually lead to it quite a squeeze on inventories and then the price. So there's that potential exists now. A true silver squeeze could be taking place.
Interesting. So today's silver market, it's facing unprecedented pressures beyond traditional industrial uses. We're seeing explosive growth in medical applications that are leveraging silver's antimicrobial properties, high-tech electronics and semiconductor manufacturing, solar panel production, electric vehicle infrastructure, emerging solid-state battery technology, advanced weapons systems. But here's what makes it different even this time around. We're on the cusp of a robotics revolution, from home cleaning robots to industrial automation, autonomous mining equipment. The coming wave of automation will require massive amounts of silver for solid-state batteries and electronics. Add in the growing energy storage needs for wind and solar panel power, and we're looking at structural demand that absolutely dwarfs anything we've ever seen before. Has there been enough investment into silver mining production in order to meet these coming unprecedented pressures? And if not, what are you expecting to happen here in the market?
Well, that's what's so amazing. When I started buying silver in college, it was about $4 an ounce, and the U.S. had a stockpile of silver. It was still dumping into the market. And then the silver price had a nice run up towards $50, and it brought some capital into the market, into these different silver projects and exploration. Kind of things got better. But for the almost last 10 to 15 years, it has been last several years, especially the silver companies and miners have had really no incentive. They've been trying more to break even or make a small profit on their silver projects. So there's been no big silver discoveries. There has been some new silver discoveries, but on the most part, not enough to be replacing what's being mined. There was a downgrade, I think, last week in the actual mine supply, 820 million ounces a year of actual silver mine supply. And that's been decreasing because there have been issues like in Mexico over the last administration. There's more and more issues mining in general. More and more people don't want the mining in their backyards. They don't like mining in general, especially the younger generation. They don't understand. They love all the AI and all the, they're talking about robotics. They want all that stuff, but they don't want the metals to be mined. So you have other costs and environmental issues. And even in the US, like under the last administration, the Bureau of Land Management has been some of them so anti-mining and making the process so difficult. So yeah, that dissuades investment. That dissuades exploration and development. The price hasn't been there. The regulation has been anti-mining, and the whole culture.
It's true.
So it really puts silver in an interesting position. It's the greenest precious metal. It's the one that's needed to take us to these new civilization, this new society we want to build. But even just for the basic needs that we have living in the West, there's a huge part of the world that doesn't have it yet. And there's so much demand for so many different electronics and you're talking, solar energy, green energy, all this. So there's mandated demand. There's all sorts of demand that's needed. Mm-hmm. And silver is used in all sorts of electronics and uses. And the investment side is just kind of that small portion of the market. So it's barely, the vast majority is for industrial needs, and that demand is just growing and growing to records. So, and it's like you said, it's not going away. That there's more and more need for it. Yeah. So that it makes the silver market even a lot more interesting. And then you look at it from the perspective of gold. Gold's here hitting record highs, and silver's just dragging along. 90-to-1 ratio. That's just pathetic. Like this is a hated market. And I'm a contrarian. I've always been a contrarian. So I always like to think whenever the mass is thinking the same way, and when everyone's talking, going to be rushing into silver, talking, how great silver is, I'm going to start, questioning that. But for right now, I love it from a contrarian perspective because people just absolutely hate it. There's no trust or belief in the reality. You've had so many false attempts, and I get it. Psychologically, it's been a difficult, long period of time. But when the silver market moves, it happens almost like in a blink of an eye. So you're either in the market or you're just going to be watching, a revaluation take place. And I think that's what we'll see. Right now, we're getting close to potentially another big leg higher in the silver price. So we'll see how that develops. But anytime it dips down here under 30, it's like, wow, that looks cheap to me. 10, 15 years ago, $30 silver is like, okay, they're producing silver for 15s, $12, $13 an ounce. Now the silver miners need $25 at least to break even a lot of these projects. So yeah, now it looks cheap to me when silver breaks under 30.
Interesting. So an explosive revaluation is what you're expecting at some point.
Well, that definitely it's in the cards, and you just look from all these different pressures. You get the investment demand coming into this record industrial demand, and the gold price is just pushing it higher and higher. It doesn't take a lot of money. It's a small market. It doesn't, and it's easier and easier now to access and buy physical metal today. Different products and so on. So you're going to get some sort of mass, interest in it, whatever size it is, and it'll squeeze the price. And that's when you got to be a little bit careful, because price gains can come quickly, and they can also drop. They can definitely overshoot. It's true in market price. So definitely be ready when you feel like it can't go wrong anymore. The silver prices, you're in control. Yeah, it takes some profits. There's nothing wrong with it, maybe not holding it in dollars or some other fiat currency, but yeah, buy something else with it, some other asset.
That's good advice. So back to the miners, nobody in this business has ever seen 50% pre-tax operating margins from the gold miners. The bearish hedge fund traders, the newsletter writers, they seem to be looking backwards to a time when the central banks had not taken control of the gold market. 2024 quarter four earnings per share is going to be reported this month in February. Backward-looking analysts are going to be shocked by the financial statements from these producing gold miners who executed their mine plans. Are you expecting miners to rip hard here?
Yeah, I mean the cash flow numbers are just becoming hard to ignore. The average gold price per cost of production has been rising, which has been a problem. But $1,500 an ounce versus almost $2,900 an ounce, that's a huge margin. So at this part of the cycle, this is when you want to be in the miners. And what's shocking is that they haven't been noticed yet, because I thought the trigger in the past has been you break a defined technical resistance in 2100, 2000. That area has been pretty well defined for many, many years. And breaking past that was quite the indicator to me that this is going to get going. But I was shocked that the miners have been almost just matching the price increase in gold. Their margins are exploding. So they should be multiples rising multiples at faster rates than the gold price. That hasn't happened. It's going to get noticed. You're seeing, I've seen some companies issue some stock buybacks because they have excess cash. What I think would help would be if the companies start issuing dividends.
That'd be great.
The last big gold run up when miners, especially the South African miners, they went up quite heavily up in price in the 1970s into the peak. And some of them were paying, I think, like 40, 50, 60% dividends, right? So there's a possibility to actually pay some significant dividends out there. And I hope the companies start to do that more and more. But
that reminds me of homestake mining in the 30s. They did that.
Yes, that's right. And the companies have been through a difficult period, no doubt. They've been struggling. They need to, they're fixing their balance sheets. They're getting rebalanced into a lot better place. So as the cash keeps piling up day, month, quarter after quarter, this is going to get noticed. The analysts will get their new models together, and a lot of the analysts use like their 2 to 3 year trailing average on the gold price. So even if you look at the 200-day moving average on gold, it was like a week ago that it finally broke through 2,500. So all their models get changed and they upgraded and they start to issue more buy signals and so on. So I really think your risk to reward is it's very favorable right now for the gold stocks, but it is also not something you want to hold long term, and you can see you can definitely pick the wrong ones, and there's a lot of risk, so you want to balance it out among a lot of different ones. But right now it's so easy to buy them. From watching this for the last 30 years, it is shocking. It's just kind of like, is anyone paying attention? Like, you're all just focusing on trumpet meme coins and ridiculous things. It's just it's a great opportunity, and that's the thing. It's like opportunities like this aren't really presented to you. You have to find them, because once you start hearing about it, well, that means everyone else, the big positions have been taken, and you're writing the last part of this. So I think it's a great opportunity for those looking for actual good value in this sector. It's actually showing itself now.
So, Peter, clearly gold producers, they're printing money with record free cash flow. Do you see this as a time where that record free cash flow could be their currency for huge merger and acquisitions and strategic alliances? Are you expecting to see major M&A activity to occur, as well as it being basically a match that lights a fire to the coming best junior resource bull market in recent history?
Well, the difficulty that I've heard and seen from the sector is that no one wants to merge with low share prices. Everyone thinks they're too cheap. So you almost need the share prices to start moving higher and to kind of get that M&A moving. We've had some, Newcrest and Newmont came together, and that was a big deal. And we've had some take place. The smart companies are the miners, and I see them make this move, is start buying these exploration companies, start buying some projects, start buying things that are selling for 10 cents on the dollar. It feels like there are just so many deals out there. And if you're starving to replace your reserves and resources, this is the opportune time. But everyone's a little bit shy, but it's just kind of like human nature. Just like once you see a lot more activity happening, everyone kind of just joins in and does the same thing. But the ones who are kind of forward looking, and I think it's not really a risky proposition at this point. The gold price is really broken out. You're sitting on a lot more cash. Just go shopping. Yeah, just start taking this stuff out.
Yeah.
But it's hard. It's always, it's not always the easiest thing to get a friendly buyout on the other side. But yeah,
that's fair. It takes two sides to tango, right? So, with the dampened investment that we've been discussing about over the last 15 years in gold and silver miners, and the consistent growth and need for both metals for many different reasons, do you expect there to come a day where that lack of investment will prove to be a major issue when it comes to production? And in that moment, what are we likely to see as the ramifications of that lengthy time frame where investment was lacking?
Sorry, I got cut off there.
So lacking into the mining complex.
Lack of investment. So yeah, for a mining company to discover and bring some projects into the market, it takes a lot of time, many years. If you go from the grassroots level, it's 1 out of 1 or 2,000 projects that becomes a mine. And then the permitting and process it varies. If you're in Mexico, U.S., West Africa, I mean, it's going to get better in the U.S. now. You've already seen the BLM change their mandate to accelerate the permitting. There's been a lot of issues, but it is a lot of capital to permitting environmental work. And just the whole process, is something that takes years. So it can't just turn on supply next day. And even more so is the industry's been gutted with, from capital and from new younger generations wanting to participate in the mining sector. Mm-hmm. So, geologists isn't something you can train to be in 4 years. Not even probably 10 years. It's like it takes decades to become really good geologists, and to do all these things, it takes a lot of skill sets and time and capital. So things can't be fixed that easily. You definitely can solve it with higher prices. I mean, you do have a lot of mines with lower grade material that could be mined if you had, the gold price at 5,000, or if you had the silver price at $1,500+ or something. So there are some ways to get more supply on like that, but to discover new projects and bring them on. Yeah, so that's why it's interesting. There are some companies that have been developing and advancing projects through difficult periods that have been able to raise capital. So those more advanced development stage or exploration projects, those ones are going to be prime targets for majors and mid-tiers as this market gets going.
Well, this has been a fantastic discussion. Before we wrap up here and I ask Peter our final question, I want to point everyone over to our Substack. Go to metalsandminers.substack.com. We post content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one with Peter. They're all up there. When you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, If You Don't Own Gold, You Know Neither History Nor Economics. This free gift is a must-read for everyone on why we all should own gold. For the premium subscribers to our Substack, we just launched something called the Inner Circle. It's a rotation of 2 to 3 monthly in-depth expert written analyses and reports into either the broader metals and miners markets or a deep dive into a specific metal or a specific miner, and they're written by the same experts that you see interviewed on this YouTube channel. The first 2 reports have already been published. They contain a lot of intelligence. If you haven't read them already, you really need to. The next report is going to be published this Wednesday, February 5th, and it's written by none other than Simon Hunt. It's on copper. Head over to metalsandminers.substack.com. Subscribe, receive the free gift on us while you're there. Check out the premium subscription that includes the Inner Circle. Also, I'm positive you've enjoyed the conversation with Peter as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video. Peter, what previous time period do you see today's precious metals bull run as an analog for, and what are you expecting for the metals moving forward in terms of price escalation, how long this bull market's going to last, and ultimately what could bring the bull to an end?
I believe this is a multi-year bull market in precious metals. It's going to go through different cycles. We've just broken out in the gold price into the next leg higher. This one, it's a little more difficult to predict short term, but I think it's going to really take us well above $3,000 an ounce. There's always triggers in there for this to really accelerate and go to much more significant levels. But I think the gold price is going to get a period of consolidation around maybe $3,000, $2,000. It's kind of hard to see where it settles down, but that'll be a floor for a while, and then it'll get going again after some months, several months maybe. So we'll go through these different cycles, and there will be some triggers and things that will come up, and we'll see how things play out politically in the U.S. and with the tariff wars and trade wars and so on. But there's going to be a need for some more printing. There's going to be some other financial crash and economic crises, some sort of something that pulls the Fed back in. Maybe it's just, Trump pushing on the long end of the yield curve, trying to keep the rates down. So there will be another QE event, more printing, and the tariffs itself is going to push price inflation up. But yeah, there's going to be other things that keep driving this forward. And on top of it is the de-dollarization globally, and that's not ending anytime soon. It's actually getting more, I would say, violent with the threats, and that's going to just continue underpinning the gold price. It's in a period of revaluation. It's been underpriced for way too long. A lot of the trend for decades has been moving gold out of Europe and the West into the growth sector of the world, which is Southeast Asia and other parts of the world, which have been buying. So the trends are still very favorable for the gold market. Nothing to really see changing in the near future. The gold price can easily keep marching past 3,000, 4,000, 5,000. If there's going to be some sort of global debt reset, some big overnight situation that we wake up to one day and we may see gold at 10, 20,000, that's always in the cards. At some point, the debt levels become unmanageable. The dollar is being dumped. I don't know. There's a lot of scenarios out there, triggers that could accelerate this. I don't think we're quite yet there, but the trends are in place. And like we saw in 2022, things take place all of a sudden you don't expect. Even with the tariffs here, people were told about this months ago. And right after the elections, the gold price dumped. People were selling it, knowing the tariffs were being mentioned. They didn't take it seriously. So things, are gonna. There's more of a reality check taking place right now, and as the West joins the bull market, that's going to add another driving force to this global precious metals bull. So this is going to keep going, and the precious metal stocks just keep getting trying to lift off the ground, but not quite taking off yet. But that will get going this year. I think that'll be a big feature, is that you'll get the miners start moving, and you will get some better gains in that side. And that, I think, will coincide with the silver price breaking past the $32, $33 level on a sustained basis, past 35. Once we move into that $40 to $50 range, that I like to watch the gold silver ratio as kind of like a sentiment indicator for the stocks, and we're at the low end. So if that ratio starts breaking through 80 and then towards 70 and into the 60s, I think that will bring more energy to the exploration side and so on. But as we're seeing with the tariffs, things can really accelerate too as well. If there's a shortage of product, that's a conditions where you get some price spikes, and we saw that in other markets in the last years, especially under COVID and also with the war in Ukraine.
Yeah, outstanding. So how can everybody learn more about your work and be in contact with you?
Okay, sure. So GoldSeek and SilverSeek.com are the websites. We'll be celebrating our 30th year on the internet this year with GoldSeek.com. And as well, I'm pretty active on Twitter or X. At GoldSeek is my handle, so you can find me on there as well.
Wonderful. I will have all that information up on the screen. It'll all be linked so people can click through. I've been following you for a couple of years. I've been on GoldSeek and SilverSeek for a couple of years. Hey, thank you and congratulations to 30 years of putting out that material. That's wonderful. Appreciate what you're doing for the community and for everybody to help uplift their knowledge and more than their experience, but just their insight into what's happening on a day-to-day basis. So really appreciate your efforts and your work. And thank you for being here with us. And I look forward to having you back on sometime soon, Peter. And everybody else, thank you for watching.
All right. Thank you very much, Gary, for having me on. Great to be on here.
Point everyone over to our Substack. Go to metalsandminers.substack.com. We post content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one with Peter. They're all up there. When you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, If You Don't Own Gold, You Know Neither History Nor Economics. This free gift is a must-read for everyone on why we all should own gold. For the premium subscribers to our Substack, we just launched something called the Inner Circle. It's a rotation of 2 to 3 monthly in-depth expert written analyses and reports into either the broader metals and miners markets or a deep dive into a specific metal or a specific miner, and they're written by the same experts that you see interviewed on this YouTube channel. The first 2 reports have already been published. They contain a lot of intelligence. If you haven't read them already, you really need to. The next report is going to be published this Wednesday, February 5th, and it's written by none other than Simon Hunt. It's on copper. Head over to metalsandminers.substack.com. Subscribe, receive the free gift on us while you're there. Check out the premium subscription that includes the Inner Circle.